We're going to review an adjustable rate mortgage, which is also known as an ARM. The most important thing to understand about an adjustable rate mortgage is that the interest rate can change over the life of the mortgage. So the borrower faces the risk of having to pay a higher monthly mortgage payment in the event that interest rates increase over the life of the mortgage, although the borrower could also pay a lower monthly payment if interest rates go down. The term or length for most ARMs is 30 years. The initial interest rate and monthly mortgage payment for an ARM are fixed and do not change for a set period of time, called the fixed rate period, which is usually the first 3, 5, 7, or 10 years of the mortgage. The interest rate for the fixed rate period is typically lower than the interest rate for a 30-year fixed rate mortgage, which is one of the reasons people select ARMs. After the fixed rate period, the interest rate and monthly mortgage payment can change on a predetermined basis, which is typically every year for the remainder of the mortgage term. This is known as the adjustable rate period. These mortgages are called 3-1, 5-1, 7-1, and 10-1 ARMs. So in the case of a 7-1 ARM, the interest rate is fixed for the first 7 years of the mortgage and then is subject to adjust annually for the remaining 23 years of the mortgage. The interest rate for the adjustable rate period is called the fully indexed rate and is calculated by adding the ARM margin, which is fixed over the life of the loan, to the ARM index, which is an underlying interest rate that can change over the life of the loan. The fully indexed rate is calculated on a predetermined basis, which is typically once a year, for the remainder of the mortgage term and will change with any fluctuations in the ARM index. So in the case of a 7-1 ARM, the fully indexed rate adjusts on an annual basis for the final 23 years of the mortgage. This means that the ARM interest rate and your monthly mortgage payment can change and potentially go up every year over the last 23 years of the mortgage. There are a lot of pieces to an ARM, so I'm going to use an example to demonstrate what the terminology means and how everything works. I'm going to use a $300,000 mortgage for this example. First, let's start with mortgage term, which is the length of the mortgage in years, and most ARMs have 30-year terms. Next, we have the fixed rate period, which is the initial period of time during which our interest rate and monthly mortgage payment do not change. The fixed rate period is typically for 3, 5, 7, or 10 years, and I'm going to use 7 years in this example. Next, we have our fixed period interest rate, which is our interest rate for the fixed period of our mortgage. Let's use 4% in this case, which means our monthly mortgage payment for the first 7 years of our ARM is $1,432. Remember, the interest rate and monthly mortgage payment in the fixed rate period is typically lower than the interest rate and mortgage payment for a 30-year fixed rate mortgage. So that takes care of the fixed rate period, and now we can focus on the adjustable rate period, which is the remaining 23 years of our mortgage when our interest rate and mortgage payment can change. First, I'm going to define our adjustment interval, which will determine how frequently our interest rate can change during the adjustable rate period. The adjustment interval for most ARMs is a year, so that's what I'm going to use in this example. Next, I'm going to define the fully indexed interest rate, which is the interest rate for the adjustable rate period of the mortgage. The fully indexed interest rate is calculated by adding the ARM margin to the ARM index. The ARM margin is a set interest rate amount that does not change over the course of the mortgage. The ARM margin is typically 2 to 3%. I'm going to use 3% in this example. The ARM index is an underlying interest rate that can change. Lenders typically use the 1-year LIBOR or 1-year Treasury note as the ARM index. These are interest rates that change with fluctuations in the economy. Let's use the 1-year LIBOR as our ARM index in this example. So in this example, let's say that at the end of our fixed rate period, the 1-year LIBOR is 1.5% and our ARM margin is 3%. The fully indexed rate is 4.5%. So in year 8, the first year of the adjustable rate period, our interest rate is 4.5% and our monthly mortgage payment increases to $1,503. Remember, this is only an example and the actual interest rates for your mortgage will be different. The fully indexed rate is recalculated on an annual basis for the remainder of the term of the mortgage and will change with any fluctuations in the ARM index. ARMs typically do have limits, also called caps, on the amount by which the interest rate can increase. There's an initial adjustment cap, which limits the change in interest rate for the initial adjustment period following the fixed rate period, so in this case, year 8 of our mortgage. The initial adjustment cap is typically 2% or 5%, and I'm going to use 5% in this example. Also, ARMs also have a subsequent adjustment cap, which limits the change in the fully indexed rate in any adjustment period following the first adjustment period. So years 9 through 30 in this example. Subsequent adjustment caps typically range from 2% to 5%, and I'm going to use 2% in this example. Finally, ARMs have a life cap, which limits the increase in interest rate over the term of the mortgage. So if our life cap is 5% in this example, it means that the maximum interest rate for our ARM over the life of the loan is 9%, which is a significant increase compared to our fixed period interest rate of 4%. Because it's impossible to predict what interest rates will be in the future, it's impossible to know what your mortgage payment will be during the adjustable rate period for an ARM. But to highlight the risks of an adjustable rate mortgage, I'm going to show you the worst case scenario, when the interest rate increases as much as possible, as quickly as possible. So let's apply the maximum interest rate of 9% to year 8, the first year of our adjustable rate period and make our fully indexed rate 9%. Our mortgage payment in year 8 jumps to $2,218 in this scenario, which is a significant increase as compared to our fixed rate period payment of $1,432. Granted, this worst case scenario is unlikely, but it gives you a sense of the risks associated with an ARM. Given the complexity and risks of an adjustable rate mortgage, you may be wondering why people select ARMs. People typically select ARMs because the initial interest rate and monthly mortgage payment during the initial fixed rate period is typically lower than the interest rate and payment for a fixed rate mortgage. So if you know that you are only going to own a property during the fixed rate period, then an ARM may be the right program for you. That way you benefit from the lower monthly mortgage payment during the fixed rate period, but you are not exposed to a potential increase in interest rate and monthly mortgage payment during the adjustable rate period. The other reason to select an ARM is if you think that interest rates are going to decline significantly in the future, although predicting interest rates can be very challenging, so this strategy exposes the borrower to significant risk. We encourage you to review related freeandclear.com videos, such as which mortgage program is right for me, and check out our detailed discussion of adjustable rate mortgages in our mortgage program section, as well as our adjustable rate mortgage calculator on freeandclear.com. Thank you for reviewing Adjustable Rate Mortgage Overview with freeandclear.com. Free and Clear.